A Zillow page usually ends with a number, a price estimate, a monthly payment, a listing price, a little box that makes a strange and emotional market feel searchable. For years, that was the bargain. Zillow helped people look at homes, compare homes, wonder about homes, and ask what a home might be worth. Then Zillow made one quiet change to the bargain. Some of those numbers became houses on Zillow's own balance sheet. That is the center of the Zillow Offers story. It was not only a tech company trying a new feature, it was a company moving from information into inventory, from showing a price to carrying the risk behind a price, from being the place people checked before a move to being the buyer on the other side of the move. And once Zillow crossed that line, every small mistake had a different weight. An estimate on a website can be useful even when it is imperfect. A house that a public company has already bought is different. It has a purchase price, it has repairs, it has taxes, it has utilities, it has financing, it has a clock. That clock is what broke the machine. Before Zillow Offers, Zillow was already one of the most recognizable names in American housing. It started Zillow.com in 2006 and built a consumer marketplace around listings, property data, home profiles, and the Zestimate. The important context is that Zillow was not starting from nothing. It had an enormous audience. It had a database of homes. It had a brand people already associated with answering the question, what is this place worth? That made Zillow Offers feel logical. In 2017, Zillow tested instant offers, a marketplace idea that let sellers receive offers from investors and compare them with an agent's estimate. In April 2018, Zillow ended that version and launched Zillow Offers as a direct buying service. The new promise was simple. If a homeowner accepted Zillow's offer, Zillow would buy the house, make repairs and updates, and list it for resale on the open market. For the seller, the pitch was certainty and control. No open houses, no drawn-out listing process, no waiting for a buyer to line up financing. Zillow would give an offer, close, fix the home, and find the next buyer. For Zillow, the pitch was bigger. Advertising was one market. The actual transaction was much larger. If Zillow could move closer to the sale itself, the company could touch more of the money around moving, the home sale, the mortgage, the title work, the agent relationship, and the next purchase. That is why the early story looks so clean. By the end of 2018, Zillow Offers was buying and selling homes in 5 metro areas: Phoenix, Las Vegas, Atlanta, Denver, and Charlotte. It had sold 177 homes and held 509 homes in inventory, worth about $162.8 million. Those numbers were small compared with the national housing market, but they mattered because the model had changed. Zillow was no longer only sending attention to real estate professionals. It was now buying real assets with real capital. At first, the company treated that as the beginning of a much larger lane. In 2019, Zillow Offers expanded to 22 markets. It purchased 6,511 homes from sellers and sold 4,313 homes to buyers. Homes revenue grew from $52.4 million in 2018 to about $1.365 billion in 2019. That sounds like proof. In 1 year, the direct buying business had become a billion-dollar revenue line. But revenue in a home flipping business is a strange signal. If a company buys a home for $300,000 and sells it for something near that amount, the sale creates a large revenue number. That does not automatically mean the business made much money. The gross number includes the price of the house itself. The hard question is, what remains after the purchase price, repairs, selling costs, holding costs, financing, concessions, labor, and the time it took to sell? Zillow's own filings made that clear. They warned that Zillow Offers depended on efficiently acquiring, renovating, and selling properties. They warned that Zillow had to estimate the purchase-to-sale timeline, repair cost, market conditions, resale proceeds, closing costs, and holding costs. They warned those assumptions could be wrong. They warned Zillow might pay more for homes than it could resell them for. That risk language is important because it was not written after the disaster as an excuse. It was the operating map of the business. Zillow Offers needed a chain of things to work at once. The company needed to value a home correctly before buying it. It needed sellers to accept enough offers. It needed contractors and vendors to make light repairs. It needed the home to be ready for sale quickly. It needed buyers to show up. It needed financing lines to support inventory. It needed local housing markets to behave within the model's range. Any one of those can be hard. Zillow was trying to make all of them repeatable. Then 2020 interrupted the system. In March 2020, Zillow temporarily paused Zillow Offers home buying because of COVID conditions. It later resumed buying in all markets by early August. By the end of 2020, Zillow Offers was available in 25 markets. It had purchased 4,162 homes during the year, sold 5,137 homes, and accounted for $1.7 billion of revenue. The pause matters because it showed how sensitive the model was to outside shocks. A marketplace can slow advertising, lower spending, and wait out uncertainty. A home inventory business has a different problem. It has assets that need to be held, financed, maintained, and sold. Zillow came out of that year with the business still alive, but the risk factors were no longer theoretical. In the 2020 filing, Zillow said the business was still unproven. It said the results were not predictable. It said the model relied on accurate home valuation and inventory management. It said the business depended on access to desirable inventory, fast resale, financing, and third-party renovation work. That is almost the whole episode before the crash happens. The public sees a house. Zillow sees a process. A house has to be priced, then bought, then closed, then inspected, then repaired, then relisted, then sold. Then the debt used to finance it has to be repaid. The margin has to survive every handoff. In a normal housing market, those handoffs can still go wrong. In 2021, the housing market was not normal. Demand was high. Supply was tight, prices moved fast, renovation labor was difficult, materials were harder to source. The pandemic had already bent normal operating patterns. A company trying to forecast resale prices 3 to 6 months out was now operating in a market where yesterday's price could feel stale. That is the phrase from Zillow's own shareholder letter that matters: 3 to 6 months. Zillow was not only estimating what a home was worth today, Zillow Offers had to estimate what the company could sell that home for after purchase, repair, holding time, and selling costs. That meant the business was exposed to the future, not only the present. By the fall of 2021, the exposure was huge. As of September 30th, 2021, Zillow's inventory was $3.758 billion. At the end of 2020, it had been $491.3 million. That is not a small change. That is a company loading billions of dollars of homes onto the balance sheet in less than a year. And the pipeline was not empty. Zillow said the value of homes under contract through Zillow Offers, but not yet closed, was $3.3 billion as of the same date. That detail is the trapdoor. If you pause new buying today, you still have the homes already owned. You still have homes under contract. You still have homes being renovated. You still have homes waiting to be sold. A pause stops the front door. It does not erase the hallway behind it. On October 18th, 2021, Zillow paused signing new contracts through Zillow Offers. The reason it gave was renovation and operational capacity constraints. That was the first public break. But the financial signal had already arrived. In the third quarter of 2021, Zillow recorded a $304.4 million write-down to inventory. The filing said a large portion of homes in inventory had costs above the estimated amount Zillow expected to recover after selling costs. In plain English, Zillow owned many homes at values the company no longer believed it could recover. That is the moment where the story stops being about a clever product idea and becomes a balance sheet event. The model needed Zillow to be close enough on price and fast enough in operations. If prices, repairs, and resale timing all moved against the company, the margin disappeared. If that happened at small scale, Zillow could learn. If it happened at billions of dollars of inventory, Zillow had to account for it. On November 2nd, 2021, Zillow announced the decision to wind down Zillow Offers. The company pointed to home pricing unpredictability, capacity constraints, and operational challenges. It also said those problems were worsened by the housing market, the pandemic, labor conditions, and supply chain issues. This is why the simple version of the story is too small. It is tempting to say the algorithm bought too many houses at the wrong prices. That is part of the surface. But the deeper failure was the whole operating machine around that decision. A pricing model does not renovate a kitchen. It does not hire contractors. It does not make materials arrive. It does not guarantee buyers will close at the price you expected months earlier. It does not make a financing line free. It does not stop a local market from changing. Zillow's own explanation pointed to that broader system. In the press release, Rich Barton said, forecasting home prices had become more unpredictable than the company expected. He also said, continuing to scale would create too much earnings and balance sheet volatility. That phrase is the whole business lesson, balance sheet volatility. Zillow had wanted to be, in its shareholder letter's words, a market maker, not a market risk taker. A market maker helps transactions happen. A market risk taker owns the exposure when the market moves. Zillow Offers pulled the company toward the second role. It bought the house before the next buyer was known. It paid repair and holding costs before the next sale closed. It took on inventory and financing before the market gave a final answer. That does not mean the idea was irrational. It means the model had a narrow tolerance for error. Zillow's shareholder letter described internal guardrails that aimed for a small margin around break-even economics. The same letter said unit economics swung sharply from the second quarter to the fourth quarter outlook. When a business depends on tight unit economics, small shifts can become large losses. A few percentage points on one house is painful. A few percentage points across thousands of houses is a corporate event. That is why the workforce impact followed so quickly. Zillow said it expected a reduction of about 25% of its workforce as part of the wind down, and the accounting continued beyond the first write-down. In its 2021 Form 10-K, Zillow reported total inventory write-downs related to the wind down of $407.9 million. It also reported other wind-down cost categories tied to employees, contracts, financing, and assets. The failure had spread through every part of the machine the business needed to run. Inventory was not just inventory. It was debt capacity. It was labor scheduling. It was repair cost. It was buyer demand. It was holding time. It was accounting. It was a promise to sellers and a liability to shareholders. That is the part people often miss. Zillow did not lose because people stopped caring about Zillow. The core brand still had a giant audience. The core marketplace still mattered. Zillow had real data assets. The Zestimate remained a useful consumer reference point, even if imperfect. The failure was more specific. Zillow took a product built around information and attached it to a business built around ownership. Those two businesses do not absorb mistakes the same way. If a home estimate is off, a consumer may still use it as one signal among many. If a company buys the home, the estimate becomes a purchase decision. The purchase decision becomes inventory. The inventory becomes financing. The financing becomes exposure. The exposure becomes an earnings problem when the resale math fails. That is the breakpoint. The company had a number people trusted enough to look at. Then it built a machine that needed the number to be profitable enough to own. For a while, growth made the machine look strong. More markets, more homes, more revenue, a bigger addressable market, a cleaner seller pitch. But growth also made the hidden dependencies bigger. Every new market required local judgment. Every accepted offer created a future sale that had not happened yet. Every home under contract kept the risk moving even after the pause. Every renovation delay stretched the timeline. Every forecast miss turned into real capital. The Zillow Offers shutdown was not a verdict that housing data is useless. It was a verdict on the idea that data, brand trust, and consumer demand were enough to make a capital-heavy home trading business stable at Zillow's scale. That difference matters beyond Zillow. A lot of companies look at a market from the outside and see friction. They see an old process. They see fees, they see delay, they see fragmented local operators. Then they imagine that a better interface and better data can absorb the mess. Sometimes they are right, but sometimes the mess is not sitting on top of the business. It is the business. Residential real estate is local, it is physical, it is slow, it is emotional. It depends on financing, inspections, repairs, contractors, appraisals, weather, neighborhood demand, and timing. A website can make parts of that easier to understand. It cannot turn a house into a purely digital asset. Zillow Offers tried to make the move easier by taking the uncertainty from the seller. That was the customer promise. The problem was that uncertainty did not disappear. It moved to Zillow. And once Zillow held enough of it, the company decided the return was not worth the volatility. That is why the ending is so clean and so expensive. Zillow stepped back from the house flipping machine. It returned to a strategy with less direct inventory risk. The homes had to be worked through, the charges had to be reported, the workforce had to be cut. The company had to explain why a business that looked like the future of Zillow had become a risk it no longer wanted. The lesson is not that Zillow should never have experimented. The lesson is that some experiments change the company before the company knows whether the experiment works. Zillow could test a new page, a new lead product, a new agent model, or a new consumer flow without owning billions of dollars of houses. Zillow Offers was different. It asked the company to prove its model with inventory on the balance sheet. And inventory does not wait politely for the model to improve. It ages, it costs money, it needs work, it has to sell. That is what made Zillow Offers a breakpoint story. The company knew how to help people look at houses. For a moment, it tried to become the buyer. The mistake was believing those two jobs were close enough that the same advantage could carry both. They were not. One job helps the market see a price. The other owns the price when the market moves.